IRAs are really common types of retirement accounts people are using around the United States, but as you know, when it comes time to take money out of them, that distribution may or may not be counted as taxable income. You may or may not have to pay tax on that depending on a couple of different factors. In this video, we're going to walk you through everything you need to know about IRA distributions, and we'll show you exactly what the IRS sees so that you can better manage your own tax situation and figure out whether you'll owe tax on that money coming out of your own IRA. Get started just a quick bit on IRAs in general. The IRA stands for Individual Retirement Account. The government allows us to use these types of accounts because the federal government wants us to save for our retirement. They're better off if we're better off in our retirement from a financial perspective. So what they allow us to do is, under certain conditions, we can put money into IRAs. We can invest money while they're in those accounts, and anything that happens in those accounts while it's inside the IRA is tax deferred, meaning we don't pay tax on any of it. So if you put $5,000 into an IRA, you invest that $5,000, and then over time the value grows, maybe from interest or capital gains or dividends or anything that happens in that account, you don't have to pay tax on any of that growth while it's still in the account. You have to pay tax on every penny once it comes out of the account in the future. And because the IRS has enabled us, allowed us to defer taxation on everything you have going on inside that account for years and years and years, they don't let you keep the money inside that account forever. You're actually forced to start taking it out whether you want to or not when you get into your mid-70s. So when the time comes to take money out of the account, let's say you put $5,000 in and then it grew to $15,000 over the course of a number of years, and then you take every penny out of that account. You distribute it to go, I don't know, buy a boat or something. Well, every penny that comes out of that account is going to be considered taxable income for that year. And your brokerage firm is going to create and present you with a 1099-R after the end of the tax year. They'll send one copy to you, they'll send another copy to the IRS. So the IRS is going to know exactly how much money came out of your account. You then need to take that piece of paper and include that $15,000 of distributed income from the account on your tax return. So the main question everybody has here is, you take money out of the account, well, how much tax am I going to owe? Well, that depends on the rest of your tax return, including a number of different variables. But rest assured that the IRS is going to know that money came out of the account, so you want to make sure, absolutely sure, you report it on your own tax return when the time comes. So let's continue on with our example. Here's a copy of the 2024 Form 1040. This is the tax return form that we all fill out every single year when we file taxes on our income that we had this year. And as you might know already, the top section of the form is where you include the personal information of the people who are filing that return, either an individual or a couple. Then you check your filing status, then you add your dependents, and then these numbered lines down here on the second half of page 1 of 1040 is where we start reporting our income. And at the top, that's where we include income maybe from work, if we were paid via W-2 wages, from business distributions, from interest on bank accounts, things like that. All this goes into the top section of your 1040. Notice here that line 4 is reserved for IRA distributions. So if you put $5,000 into an IRA and then it grows to $15,000 and then you take all that money out, you're going to get a 1099 from your brokerage firm for $15,000. And that $15,000 needs to show up in this line because the IRS is getting a copy of that same document that's a report of how much money came out of your account. But notice also that it may or may not be taxable depending on a couple different circumstances. That's what 4B is. So take, for example, let's say that you do an IRA rollover from an IRA into a 401k plan at work. Let's say that you have money in the IRA, that $15,000, but then you turn around and get a new job that has a 401k plan, and you want to consolidate the 15,000 in the IRA into that new 401k plan. Well, that will still trigger a 1099 because the money came out of the IRA. Your brokerage firm is going to send you the 1099, meaning that this line should read $15,000, but the taxable amount is going to be zero because it's a qualified rollover into another retirement plan. So for all intents and purposes, in that circumstance, when you file your return, you add up all your income like you would here normally, but none of that IRA distribution is going to be taxable to you. Another variable here has to do with basis. So basis is going to determine how much of that distribution is actually considered taxable income. So back to our example, let's say you put $5,000 into the account, it grows to 15, and then you take the money out some years later. Well, if you deducted that $5,000 contribution initially, you have a basis of zero. Basis means your contribution to the account that you paid tax on already. And if you put $5,000 into the account that you did not pay tax on because you were eligible for and took the deduction in the year that it went in, then you have a basis of zero. And when the $15,000 comes out of the account, you're paying tax on the entirety of that $15,000, unless it's an eligible rollover like the example we just went over. Now, if you don't deduct the contribution for whatever reason, maybe you're not eligible to, maybe you decided not to on your return for whatever reason, well, then you have a basis of $5,000 in the account. And so if you take $15,000 out, yes, for A on your tax return, that line we were just looking at is going to show 15,000. But you've already paid tax on $5,000 of that amount, meaning 4B is only going to show 10,000. Because you only have to pay tax on the difference between what came out of the account and your basis, which in this case is $5,000. Now, if you're going to go that route, if that's true in your situation, you have basis in an IRA, you have to track it on a supplementary form called Form 8606. What you're supposed to do with Form 8606 is every time you put money into an IRA that you do not deduct or that you have a basis in, you're supposed to file this form with your taxes. And for simplicity's sake, it's probably best to include that form every year from that point on, just to keep track of the basis that you have in your IRAs. And you can see here is that when you make a contribution to the IRA, that's not deductible, that gives you basis, it asks for it right here in line 1. And then it asks for total basis across your traditional IRAs. So you start with non-deductible contributions from this year. What is your basis in IRAs from previous year? You add those two together. That's your total basis across your IRAs. And the rest of the form here runs through a calculation to determine how much of those distributions are going to be taxable on your return this year. There's also some other sections here that we're not going to cover today, but you get the idea. So when you take money out of the IRA, it's all going to show up on a 1099, but if you have basis from prior non-deductible contributions, or maybe non-deductible contributions this year, it's not all going to be counted as taxable income. So as you can see, it gets a little bit tricky when you're trying to figure out the ultimate tax consequences of the IRA distributions. Now, I should also add here that if you're unsure whether or not you have basis in your IRA, if you've never heard of this before, if you're kind of baffled by it all, chances are you don't. Okay? If you do have basis in the IRA, just make sure that 8606 is filed along with your tax return so you can keep track of those of that basis over time. Because what will happen is if you don't, it's easy to lose track of it, and you might wind up paying tax twice on the money that went into the account initially. So for our example, if you put $5,000 into the account, you didn't deduct it initially, and then later on you take $15,000 out, well, if you don't have Form 8606 to go with your return, it might mean that you're paying tax on the entire $15,000 distribution, where 5 of that you've already paid tax on and could theoretically not have to pay tax on again. Well, the million dollar question here that everybody's wondering about is how much tax will I owe on this distribution? And as you can see, that comes down to the rest of your tax picture. As you know, we have a progressive tax system. The more income you have, the higher rate of tax you're going to pay on these withdrawals from your IRA. The brackets go from 10% to 12% to 22%, 24%, 32, 35, and then ultimately 37% in the highest brackets for high income folks. So the best way to handle this is to figure out what your income is going to be for the year. Do some kind of, at least a loose projection for what bracket you think you're going to fall into, and then expect to pay that portion of your IRA withdrawal when you file your taxes for the year. So here's back to our tax return example. We add up all your income that you think you're going to have for the year, including interest on savings accounts, income from work, rental income, business, capital gains, Social Security, pensions, any of that stuff. You add all that stuff up, you get to line 11, which is your adjusted gross income. Then we take away from that our deductions, either the standard deduction or itemized deductions. What's going to be different this year and for at least the next couple of years is we also have a potential deduction for filers who are 65 years or older, filers who get paid in overtime or tips, and there's a potential deduction for auto loan interest. This is all subject for another day. But you add up all your income, you subtract from it your deductions, and that gets you to your taxable income here on line 15. So let's say that you're married filing jointly. That's your tax filing status for the year, and you have taxable income after going through that exercise of $200,000. Well, in 2025, as I record this, that would put you in the 22% tax bracket, meaning that if you take $15,000 out of your IRA, you're going to pay 22% of that on towards your income taxes, assuming that you have no basis in the account at all. You take $15,000 out, that the entirety of that $15,000 contributes to taxable income. That means that you'll pay 22% of that, or $3,300 to the IRS when it's time to file taxes. And if you live in a state that has an income tax, I live in California, California has an income tax, you'll owe tax to your state income tax authorities as well. Now, when it comes to paying this tax, so $15,000, if you're in the 22% bracket, that winds up being $3,300, you're going to have to pay to the IRS. You have a choice. Either you can take the $15,000 out of the IRA, keep the entire $15,000, and then pay the tax, the $3,300, when you file your return for that year, let's say in March or April of the following year. Or you can also instruct your broker to withhold from the transaction for your benefit. If you take the latter and have your broker withhold from the transaction, that means that you take $15,000 out of the account, they withhold $3,300, and then they send you a check for whatever's left. In this case, $11,700. The $3,300 goes directly to the IRS, and that way when you file your taxes, the tax on that distribution is already paid for. There's no right or wrong way to do it, but you need to be aware that if you take the full $15,000 out and expect to pay the $3,300 when you file your taxes at the end of the year, it's possible that you could get yourself in a situation where you pay the underpayment penalty if your quarterly estimated taxes and withholding contributions from W-2s and other 1099s are not large enough. So this is a question for your tax professional. It takes a little bit of massaging. The safest, easiest way to do it is to have your broker withhold from the distribution for you. But if you're on top of it and want to keep the cash, you can have them withhold zero and send you the entire $15,000 too. The last thing I need to comment on in this video that you definitely need to be aware of are called early distribution penalties. Everything that we've talked about in this video so far has to do with the taxation of your IRA withdrawals. Hopefully we've covered that in sufficient depth to answer most of your questions out there. This all assumes, what we've assumed here is that you're at least 59 and a half years old when you're taking these distributions. Because the IRS gives us this nice tax advantage of deferred growth in the account. Remember what we talked about at the beginning of the video here? You put money in the account, you invest it, it grows, all that's tax deferred. You don't pay any tax on it until it comes out later on. The catch, the caveat here is that it needs to be used for retirement, meaning that they don't want you to take the money out before you're 59 and a half years old. And if you do, you might be subject to an additional penalty. And that's on top of the other caveat, which is the mandatory distributions when you get into your 70s. So if you're younger than 59 and a half and you start taking money out, there are a few qualified exemptions. There's a modest amount that you can take for, let's see, I think first time home purchases are one, disability, and there are a couple others. But by and large, if you take money out before you're 59 and a half, you'll pay tax on the distribution and you'll have to pay an additional 10% penalty. So as I mentioned, there are a couple exclusions. There's also a way around that called substantially equal periodic payments, pursuant to Section 72T of the tax code. Look into that if this is of interest to you, but make sure you're aware of what these penalties are, in addition to what the tax treatment of your distributions are if you're taking money out of the accounts. Make sure to subscribe to our channel if you haven't done so already, and download the 5-step retirement income plan if you're approaching retirement and haven't quite figured out how to turn your nest egg into income that will actually pay the bills after you stop working.